we are with Bob Iaccino, the Chief Market Strategist and co-founder of Path Trading Partners. And today we will discuss about the 10 stock market myths to avoid from Peter Lynch. And Bob will walk us through the important points of the Peter Lynch kind of study, article, presentation, whatever you call it. Hi, Bob. How are you doing today?
Good, Badish. How are you?
Not too bad. Another week, more stabilized than last week, I would say, in terms of market conditions.
Today's a very important rally that we're having in terms of stabilizing this sort of up move and responding to one of the things I said was when the NASDAQ was falling was that this is the dip to buy. I told our clients that, I believe I said it in here as well, but that there was a dip coming that you shouldn't buy, but this was not it. This was the one you should buy. So it's working out that way. Yesterday in a live session. All right. So these are both QQQs. Okay. So if you remember last week, we drew this trend line. We did it live on this session. Okay. And the reason I know that is because I haven't changed the NASDAQ and I haven't traded it since that session because we never got a close below this trend line. So you remember I was saying that we went up into the rotation zone and broke, and this was a sell for me. And then I said, okay, so now we're going back up into the rotation zone. And if it breaks this trend line, I'll sell it. It didn't, right? I've marked off this white box here as an area of resistance that I thought the market might turn at. But I said I would not, let me zoom in on this one. I would not sell it unless it broke the trend line, despite it going into resistance. And this is the problem with sort of vanilla support and resistance, right? Is if you just play off of just plain old support and resistance, you're going to get times where they break and you don't understand why they break. Well, the rotation zone not only didn't act to rotate the market because the market was too strong, but it also has turned back up now on a daily basis. Now, yesterday in another session, it wasn't with you guys. I pulled up. Now I'm going to get rid of this trend line here. All right. I pulled up a 60-minute chart for some other clients. And they said, well, explain to us about the rotation zone. I said, okay. And this was shorter term traders. I said, we've gone into the rotation zone here. We broke it, but we closed above it. So I'm going to draw a trend line here. And I did this for my clients, and I will point this out to them next week when I meet with them again. I said, if it breaks this trend line, I'm going long. And it did toward the end of the day yesterday. It closed above it on an hourly basis yesterday before the overnight session. So I went long the QQQs near the close yesterday when I got this close, and this is what we have today. So this is the kind of thing, where as I put these things together with trend lines and rotation zones, et cetera, this is the kind of way that I trade off of those things. I want the other line. I don't want this one. It doesn't matter, but I just like things to look a certain way. So anyway, when I drew that trend line for our clients yesterday, that the session that I held was about 11 in the morning, right? So it was about here. And I drew this trend line and said, if I get a positive candle close above it, I'll go along the QQQs. Now I'm going to continue to show you guys this kind of thing with the rotation zone, playing against vanilla support and resistance, et cetera. But this was a long trade that I took yesterday and it rallied through. So as soon as TradeZero gets all the recordings up and go back and watch the rotation zone and think about what I just showed you here. God, this is so bright. It's driving me crazy. But you go back to showing you some of the things that I showed you in the earlier sessions, and you'll start to see these things turn up.
I wonder your opinion on the inflation data, the kind of quick highlights of the week as we seen some strength on the tech stocks, and what's the overview of the market?
So inflation was a good news for the Federal Reserve, and it was a good news for stocks. And here's why I say that. Inflation came in. So there's three things you look at when there's a piece of economic data. Okay. The way that inflation appears versus market expectations. Okay. Another one is the way that inflation appears versus the soft whisper number of expectations. Okay. Yesterday, we had an expectation on CPI, and the market came in the way that expectations were set. But in the market, there was a soft whisper of a miss on the number, an even softer than expected CPI number. We didn't get that. We got it right on expectations, which honestly is very rare. That economists are terrible at their jobs, and it's very rare that they get it right on like that. So the number itself didn't cause as big a rally, or I should have said as big a position adjustment as you would have thought. Initially, it caused a stock market sell-off, especially in tech. Through most of the day yesterday, the NASDAQ was negative, right? It was toward the end of the day that I got my long signal. So based on that, you're looking at a scenario where not only were there expectations to look at, but there were also whisper numbers that you guys may or may not hear. Okay, I hear it because I'm talking to people all day and I'm in all these sessions and all that. So, but the inflation number itself was good news for the Fed because it allows them to do a policy adjustment as opposed to a series of rate cuts. Remember, the beginning of August when the NASDAQ sold off so hard, and we'll say all the indices did, but you asked about tech. When the NASDAQ sold off so hard, it was because the market started panicking that things were way worse. And the Fed was going to have to do an emergency 75 basis point cut if you listen to Professor Jeremy Siegel, or if you look at some of the other people saying they need to do 50 in September and then 50 in November. Crazy talk. That was crazy talk. So this inflation number allows them to do a policy adjustment, which is the most mild outcome because it lowers interest rates, but keeps the Fed in a place where they believe the economy is strong enough where they don't have to go overboard. So it's a very good result for the stock market. Also part of the reason I was looking at longs.
So we can take it as a positive news.
It was a positive number. Retail sales is the same. We have a robust consumer, which allows the Fed to just cut a little bit as opposed to panic. The economy's collapsing. We need to cut now. They don't need to do that anymore or even think about it or even address it. So.
Got it. Thanks for that, Bob. I'm really also excited about the Peter Lynch study, and I want to hear that 10 stock myths or 10 words to be avoided about stocks.
Peter Lynch's 10 most dangerous things people say about stocks. Now, the original story, because I knew someone who worked for Peter Lynch, he said it was the 10 dumbest things that people say about stocks, but he didn't want to put that. His team said to him, no, you sound mean and arrogant, which he wasn't. Okay, just so you guys know. Very, very bright, very confident. He's still alive, by the way. But he's very confident in what he knew, but he wasn't a jerk at all. He was always willing to talk to people at his events, things like that. He was a nice guy. So, and my friend that worked with him went on to have great success as well, and he attributes Peter to that success. So, who was Peter Lynch? If you don't know, he's an American investor, mutual fund manager, author, and philanthropist. He was the manager of the Magellan Fund at Fidelity Investments, which is like the original gangster, the OG, the original long-only mutual fund. And he averaged a 29.2% annual return, more than double the S&P 500 over the time that he ran that fund. It was the best performing mutual fund in the world when he ran it, since taken over by, what's his name? You guys will know his name. Ray Dalio.
No.
Ray Dalio. Yeah. His mutual fund took it over, but it was after Peter Lynch left. And Ray Dalio's mutual fund it isn't just long only stocks. It's both. So anyway, but he was just the best, to me, way better than Warren Buffett. You know why? Because he bought stocks. He didn't go buy companies. He didn't go buy 10% guaranteed warrants from Goldman Sachs during the financial crisis. He just bought stocks. So he's more like us than Warren Buffett is. So let's just go through these since my power outage made us run out of time. So here's the first one. If it's gone down this much already, it can't get any lower. I know you guys have experienced this, okay? This to me is the number one. It's not just number one on the list. It's the most important one. Our whole thing of me doing these shows is risk. When something goes down, it's more likely, statistically proven by studies, to continue to go down than it is to reverse back up. Okay? The probability is that it's going to go lower. But at the end of the day, if you decide what your risk is before you get into something and you get out and that happens, you've succeeded, even if it turns around and goes higher, because you've stayed within your risk parameters and you've lived to fight or lived to trade another day. And that's the most important thing. Number two, if it's gone this high already, how can it possibly go higher? Okay, same thing. This is why we work with targets. And I've said before that a target is not necessarily a place where you cover a trade. A target is a place where an action is required. That action could be you get out of the entire trade, you get out of a portion of the trade, or you put in a trailing stop and stay in the trade. Things that are moving higher tend to move higher continually. They don't tend to reverse. We've seen that with NVIDIA. How many of us with NVIDIA have said, as soon as it comes down, I'm going to buy it? And then what happened the first time it came down? It kept going down. And now it's headed back up. So this is basically a nice way of saying the trend is your friend in either direction. Okay. Number three, eventually they always come back. Ask people who owned Lehman Brothers, who owned Smith Barney, who owned General Motors before the government took it over and then IPO'd it back out about 2 years later. Stocks can go to zero. Okay, we all learned that during the financial crisis. Some of you may be new to investing. You may not have been investing in 2009. Okay, if you are, trust me, they don't have to come back. Cisco, which I recommended to our clients yesterday. It's another thing I wanted to show you guys yesterday. I told you earlier that I was happy because Cisco was up 9%. I recommended it to our clients. You know when Cisco reached its all-time high? 1999. It's never been back there. Okay, never. So they don't always have to come back. It's at $3. How much can I lose? Well, there's two parts to this. Number one, it depends on how many shares you bought. If you bought 10 shares, you can lose $30. If you bought 100, you could lose 300. If you bought 10,000, you could lose $30,000. Statistically, stocks under $5 are more likely to go to zero than they are to go to 10. Okay, I did a study on that myself, right? Much higher probability that they're going to go to zero. So when something's at $3 and you're saying, well, it's only $3, that's not the case. It's only $3 times the amount of shares you buy. So be very careful if you believe that.
Also with the margin accounts, I think that's more risky.
100% true. That is 100% true. Because people might have $1,500 in their account. So they say, okay, with $1,500, I can buy 750 shares, right? And then they do margin. They end up with 1,500 shares and it just gets worse, right? Or I should say 150 shares. But anyway, number five, it's always darkest before the dawn. That's the same way of saying it can't go to zero, right? Or they always come back. This is another nice way of saying it. I have a friend in the military who said that the military phrase is, it's always darkest just before it goes pitch black. That's what they say in the military, okay? In other words, it's about as dark as it can get just before you die from your wounds. So be careful about thinking this during stock market investing. This one is great. When it should say when it rebounds to 10. When it rebounds to $10, I'll sell. Now this assumes that you bought at $10 and it's come down lower than that. Another study that we looked at, we didn't do this study. People, when they buy a stock at a price and it starts to collapse and they start moving their stop lower, or they start saying, well, I'm just going to give it a little bit more and it goes lower again. I'm going to give it a little bit more and it goes lower again. Then they start to say, if I could just get my money back, I'll sell it. If I could ask for a show of hands in this room, how many people have said that? I'll bet you it'd be almost everybody. But what most people do then when it gets back up, they go, well, it rallied all the way back here. Maybe it goes to 11. Maybe it goes to 12. Maybe I'll wait. And then it turns around and goes back down again. And it's just, We'll use Peter Lynch's word and you say dangerous. But if we were using Bob Iaccino's word, I'd say it's just stupid. Cut your losses and get in something else, and cut your losses where you originally said you were going to. If you bought it at 10 and it went to 8 and you said, I'm getting out at $7.80, get out at the damn 7.80. Don't wait till it comes back, because it probably won't. I don't have to worry. I own conservative stocks. Lehman Brothers, Bear Stearns, General Motors, all very conservative stocks. Cisco is now a conservative stock. Never got up to its all-time high again. These stocks can go to zero. Depends on how much you have in them. And conservative stocks can sometimes be the worst performers in blowout markets because people have profits in them. So when they're trying to raise money in things that are really collapsing, in other words, they're selling NVIDIA because it's falling off a cliff and they want to hold that until it gets back to 10, or rather gets back to their entry point, they sell the conservative stocks. So be careful about that. Look at all the money I lost because I didn't buy. This is one of my favorite ones, okay? You can't lose money if you didn't trade. So for my clients that didn't buy Cisco yesterday when I told them to, they didn't lose any money. They didn't lose any money. They didn't make any money, but they didn't lose any either. Don't look at a missed opportunity of a trade as a loss. Okay, it's not. Losses beat you up psychologically inside, like you can't even believe. You can't make up for that. So don't add losses on missed trades. You're already going to beat yourself up on losses, which you also shouldn't do, which leads us to the next one. Stock is going up. I must be correct. It's going down. I must be wrong. Nope. If you attach your right and wrong to whether the fact made a profit or a loss, you've lost as a trader. You are right if you followed your process. You are wrong if you did not follow your process, whether it makes a profit or whether it costs you a loss. Either way, you're right if you followed your process. You're wrong if you didn't. Now, if the stock makes a profit, fantastic. It was one of the profitable trades within your process. If your stop is at a loss and you followed your process, fantastic. It's one of the losing trades within your process. No one has created a 100% profitable process. No one, not one person. But you're wrong if you go against your process, and you're right if you follow your process. The profits and the losses balance out over time if you stick to a process. Now, this last one, I don't necessarily agree with, okay? Avoid long shots. I'm going to adjust this one a little bit. I'm going to say avoid long shots where you have not calculated and controlled the risk. Mm-hmm. If you want to calculate and control the risk, you could take all the long shots you want. Just understand that a long shot has that name for a reason, because it's unlikely to work. Okay, it is unlikely to work. So that means you should not have a high amount of risk allocated to long shots. I bet on football. Every year I bet the Bears to go to the Super Bowl. The last time I won that bet was 1985. Okay? So we're coming up on 40 years of it. Yes, I was old enough to go to a casino in 1985. 40 years ago was the last time I won that bet. It's 39 years this year. But I bet it every year because they're my team. I don't know if you guys can see in the corner right here, there's a little mini Bears helmet. Can you see that?
No, actually.
Right there. You don't see that?
No.
I'm going to grab and show it to you guys.
There you
go. There's a mini Bears helmet right here.
All right, yeah.
It's on my shelf, along with a statue of my favorite Chicago Bear bobblehead, which is Walter Payton. I'm a Bears fan, okay? I'm going to lose that bet every year. Anybody want to take a guess how much I bet? Anyone?
$100.
$25.
Okay.
It's just fun for me. Okay. Now on sports bets that I believe I have a probability of winning, it's $100 to $200. Okay. I never bet more than that because I waste enough money. I bet enough money in the markets. Right. So, but it's for fun. But I put $100 to $200 in the ones that I've researched and I think they have a chance of winning. And I put $25 on my fun bet. Okay. Because I'm a Bears fan. I don't think you need to avoid long shots. I think they're fun. I just think you need to make sure that when they do not succeed for 39 years, as my Bears bet has not, the money doesn't matter. It's just a little thing you did for fun. Quinn, you took a quarterback that I love, Justin Fields. I don't necessarily think that he's great, but he is a great person. I met him. He's an unbelievable individual, and he's an incredible athlete. I hope he does really well with the Steelers because my second favorite team is the Pittsburgh Steelers.
Okay. What about Packers?
I hate the Green Bay Packers. Stop, Bodish. Don't ruin our friendship. Not ruin our friendship here.
No, just because I've been in Wisconsin, I was kind of familiar with it, but I'm not going to mention it again.
Don't ruin our friendship.
All right.
Okay? So I hope you guys can understand why I wanted to show you guys this PowerPoint. Okay. And with the permission of TradeZero's compliance, they have it because they had to approve this session. I would like all of you to have it. All right. I'd like to correct the one typo in there and I'd like to put my notes on slide 10. But if they approve it, I'd like to get it sent out to everybody because you should have it on your desk.
Okay.
All right. It's just such a really good thing for traders.
Bob, do you have any golden nuggets, final thoughts before we wrap up?
Yes, I do. And it attaches to this. Do not attach your personal value to your wins and losses. Okay. Attach your personal value to whether you follow your process or not. Because the only way you can fix your process, if your process has a problem, is if you're consistent with it. Think about a chef. Okay. A chef makes a recipe and they take a book like this that I have in front of me every single day and they write down notes. And then when their peers or the people at, whatever, their people that work for them, their peers, their clients taste it, it's good, but it needs more feta cheese, or it's good, but it needs more fennel, or whatever it is. Then he writes that down. Okay. But then the next time, if he does the suggestions of the other chefs and of his clientele and of his staff, but he changed something in the original recipe, all is lost. So follow your process. I don't know what Adolfo is saying there, but I see it, what he's saying there. Okay, I see what he's saying. He says, thanks, Ben. As a trader, we need to be constantly challenged. He's right. Mm-hmm. He's right about that. But anyway, so that's the last nugget. Attach your personal value in terms of whether you're successful on the day as to whether you followed your process to the letter, and then adjust your process. Okay. Don't adjust trades.